Did you know that over 90% of new investors lose money in the stock market? Imagine working tirelessly for your paycheck, saving diligently, and then watching your investments plummet. Why does this happen? Why would people risk their hard-earned money only to face disappointment? You've likely heard countless times that controlling emotions is crucial in the stock market. Fear and greed are the primary emotions that traders and investors battle. But how do these emotions manifest, and why are they so difficult to control? Imagine you have some money to invest. You observe the stock market and see prices fluctuating daily. When a stock's price rises, it's easy to assume that the company is performing well. Conversely, when a stock's price falls, you might suspect something is wrong with the company even if you know it's fundamentally sound. This doubt leads you to seek out news and articles that confirm your fears, creating a cycle of negativity in your mind. You start believing that the stock will continue to fall and may never recover. Consider your friend Sarah, who invested heavily in a rising tech stock. When the stock dipped, she panicked and sold, only to miss out on a later recovery. Her fear of losing everything led her to make a hasty decision, costing her potential gains. On the other hand, when a stock is rising, positive news is abundant, and the allure of quick gains becomes irresistible. This is when greed kicks in. You convince yourself that the stock's price will keep climbing, leading you to buy at high prices. The fear of missing out, FOMO, becomes overwhelming. You make a big mistake by investing heavily in a single stock, hoping to catch the rally and make substantial profits. This emotional cycle repeats itself. You invest heavily in a rising stock, only for it to drop, triggering fear. As you see the broader market rise while your stock falls, fear intensifies. Eventually, you sell at a loss, blaming bad luck without learning from the experience. The truth is, nothing is ever as good or as bad as it seems in the stock market. Diversification is the fundamental strategy to counteract the detrimental effects of fear and greed. By spreading your investments across multiple stocks, you reduce the risk associated with any single stock's performance. Suppose you diversify your investments into 30 different stocks, capping any single stock at 5% of your portfolio. If one stock declines, the impact on your overall portfolio is minimal. You can remain calm, knowing that your investment in that stock is limited. Even if a company isn't performing well, the small allocation means it won't significantly affect your portfolio. This approach allows you to stay invested longer, recover from downturns, and potentially grow your investment over time. Index funds like the S&P 500 are often recommended for their automatic diversification. However, there's a critical aspect that is often overlooked. Index funds allocate investments based on market capitalization. This means more money is invested in larger, often overvalued companies, while less is allocated to smaller, potentially undervalued ones. Think of an index fund like a pie divided unevenly. The largest slices go to the biggest companies, regardless of their current value. This means more money goes to potentially overvalued stocks, while undervalued ones get smaller portions. For example, if Microsoft has a 7% weight in the S&P 500 and the fund has $100 million to invest, it must allocate $7 million to Microsoft. If Microsoft's stock rises and its weight increases, the fund will invest even more at inflated prices. Conversely, if McDonald's weight drops, the fund will invest less, even if the company is performing well. This isn't true diversification, but rather diversification, as Peter Lynch termed it. If you understand this concept and have a monthly savings to invest, consider whether to invest in an overvalued stock like Microsoft or a potentially undervalued one like McDonald's. If you still prefer Microsoft, sticking with an index fund might be suitable for you. However, recognizing the flaws in index fund diversification can lead you to make more informed, strategic investment choices. A common misconception is that you need a large sum of money to create a diversified portfolio. However, small investors can start with modest amounts and gradually build a diversified portfolio by investing in one stock at a time. Begin by thoroughly researching and selecting a stock from a stable, growing company. Once you've invested in your first stock, save up and invest in another stock from a different industry or sector. By consistently adding new stocks over time, you can achieve diversification without needing a significant initial investment. This method allows you to take advantage of dollar-cost averaging, reducing the impact of market volatility and spreading risk across various assets. Through patience and strategic planning, even small investors can create a robust, diversified portfolio. Many investors buy stocks without understanding the companies behind them. To make better investment decisions, it's crucial to know some basic facts about the companies you're investing in. When investing in any stock, you should at least understand the company's basic financial health. Look for companies with strong brand value, consistent profitability, low debt, and growth potential. You don't need to be a financial expert to analyze these factors. By familiarizing yourself with a few key financial metrics, you can significantly improve your investment decisions. If something seems off or you have doubts, it's better to avoid that stock and look for other opportunities. The stock market offers plenty of opportunities for informed investors. Before investing, check the company's brand value, profit history, debt levels, and growth potential. These basics can save you from costly mistakes. Investing with borrowed money or margin adds another layer of risk. Here's why you should avoid leverage in your investment strategy. Borrowed money comes with the obligation of repayment, often with interest. The stock market is unpredictable and a downturn can happen at any time, leaving you with losses and the pressure to repay your debt. Life is full of surprises, and financial crises often coincide with personal challenges such as job loss. In such cases, you may be forced to sell your investments at a loss to repay the borrowed money. By investing only your own money, you eliminate the risk of forced selling and can afford to wait for the market to recover. Imagine if Sarah had borrowed money to invest in that rising tech stock. When the market dipped, not only did she face losses, but she also had to repay her loan with interest. This double blow would have forced her to sell at a loss, further compounding her financial difficulties. Options and futures contracts add another dimension of risk by working against time. Most of these contracts expire worthless, making it difficult to consistently make money. It's better to stay away from these complex financial instruments and focus on investing in equity with your own money. Understand and manage emotions. Recognize the impact of fear and greed on your investment decisions. Diversify effectively. Spread your investments across multiple stocks to minimize risk. Be informed. Conduct thorough research before investing in any stock. Avoid leverage. Use only your own money to invest and steer clear of borrowing or complex instruments like options and futures. Investing in the stock market requires a clear understanding of the emotions at play. Effective diversification strategies, informed decision-making, and avoiding leverage. By following these principles, you can navigate the stock market with greater confidence and increase your chances of long-term success. Remember, investing is a journey, and with the right knowledge and strategies, you can achieve your financial dreams. Start today by making informed choices, embracing the power of diversification, and taking small steps to grow your portfolio. If you found this video helpful, please like and subscribe to our channel for more insights and tips on successful investing.